Greetings, Dr. Jeffrey Scott here, and this is my weekend market update for July 7th, 2024. Thanks for all the great wishes that people gave me and the prayers. Actually doing this much faster than I thought I would after recovering from my surgery. And whenever the name radical is in your surgery, assume it's not an easy surgery, and it wasn't. Um, Hopefully each day I'll continue to improve, but as I told my wife, doing these things is actually therapeutic for me. It gives me something to do and is something I really enjoy. So again, thanks for all the kind wishes and thoughts that people shared. I thought back to my days of my youth. I believe it was Neil Sedaka with his high-pitched voice singing about breaking up is hard to do. And then you got Sam Hunt, who's got a song about breaking up is hard to do. And the more I thought about it, it's kind of like how I feel with this bull market. As much as I don't love it as much anymore as I did in October of 23, as much as I can find all the flaws, it's hard to break up, even with a bull market. And I'm going to talk about that as we go further. So again, thanks for being here. Jeffrey Scott is my name. hgsidoc@gmail.com is my email. Hit the subscribe button if you're new. And hit the alarm if you want to be notified when I post these. Hit the up arrow, the like button. It helps me get more visibility on YouTube. I really don't market. I don't have a site. I don't do anything to promote except I just try and put out good information, and hopefully it captures enough people that it makes it so I'm worth my time. And I do this because it forces me to follow a standard way of looking at the markets, which for me has been something that has kept me on the right side more often than not. So this is for educational purposes only. Anything I talk about should be considered education and take it in that spirit and not investment advice. I am a doctor, not a broker. I am independent. Tools that I use are tools that I've paid for. No one says I should say good or bad things about their tools, because if they did, I'd probably not say anything, or certainly nothing good. And trading involves risk, and you're solely responsible for any decisions you make. So any comments I make, any of my thoughts, anything that is my impressions are mine and mine alone. I do get the honor of speaking at Rob Hoffman's Wealth 365 event. I don't have a mailing list, so I think he just does it to be nice. But hey, being nice is good. So if you can support me by clicking on the link, and I'll put this under the YouTube video in the remarks section, I'd really appreciate it. It's free. It's you're not committing to anything. I don't get a copy of your email address, so I'm not going to bombard you with anything. And my slot is on Friday, July 19th at 9 a.m., which is a really great slot because then there's a trading competition that occurs afterwards. If you like these videos, but you say if only they were 5 to 10 minutes, I do those too, and they're at stocksanddocs.com. I hope to resume those this week as well. So I've expanded my major markets list a bit because I think there's a story here. First of all, we had a 4-day week, so the beginning of the week versus 5-day change may be different because if you think about it, Thursday the market was closed. So the first thing is, if you look at on the week, most of the things were up. Now the S&P equal weight was down a bit. The Russell 2000 was down even more. On the upside, look at the week's work for the Qs. Massive week on the NASDAQ composite and the Qs. Tesla had a huge week driving ARKK up 4.3. If you look at on Friday, even more positivity, although the equal weights were flat and the Russell was down 0.5. So it was a good 4-day session in the market. Now, I did add a couple things to see. In orange, you've got the QQQ equal weights, and you got the RSP, which is the S&P 500 equal weights. If you look since the beginning of the year, the equal weight S&P is up 3.7, and the equal weight Qs are up 6.6. So clearly are lagging their big brothers. If you look at off the bottom, and the bottom for this markets was at the end of October of 23, as you could see here. and you look at the QQQE is up 28.5% off of its bottom. The RSP is up 22.80. So, you can make things look beautiful and ugly with how you describe them with words. Yeah, they're laggards, but they've had big moves, and frankly, off their lows, they're in bull markets. So, I think we have to be careful as we condemn how bad the equal weights are. They're not doing horrible. They're just not doing great. And imagine if they started breaking out. What else do I see here? Big week for consumer discretionary, up 3.4%. Technology still up 2.8%. Communication. So back to growth led. Now there actually is an ETF, which I'm sure everybody knew, for the Magnificent Seven, MAGS. It's up 46% since the beginning of the year. It's up 75% since the bottom of the market. And that clearly, these seven are big drivers, and they drove again up 7.5% in the 4-day week. So interesting week in the market. Q Edge tool. Now let's put a little bit of a flame suppressant on my bullish sounding beginning. The Q Edge tool gives me an opportunity intraday to understand what's going on underneath. It allows me to look at intraday, what sector performance is, industry performance, and stock performance. Now, since we are at the weekend, there's no intraday, so it's giving me the end of day. It also allows me to look at over time, 1 month for those three, 10 days, 5 days, 2 days, and 1 day. So even though you can argue there's a lot of green here, 2/3 of the industry of the sectors were down on Friday. It was about 90% at lunchtime, so it improved as the day went on. Industry groups, 72% were down, and 66% of stocks were down. So when you start to put all these things together, there's a lot of pressure in this market despite the indexes being positive. This here, the buckets I'll come back to, but there's no big signal there. And if you look at over time, it's mostly an ugly looking market, which got worse into the end of the week. So on a broader scale, going beyond the big mega caps, yeah, the market does show some weakness. Here's the market breadth tool from my buddy Cigar. And this here combines the NASDAQ composite and the NYSE, and it gives me signals. Now, the blue up arrows is called a bango, and a bango is a signal of exuberance that you get in the period when the market's being marked up, and it's the kind of thing that's kind of think back to Greenspan's commentary about irrational exuberance. It's not it's not the end of the world, but it tells you the market's starting to get stretched. As you can see to the left, it can get really stretched. The skull and crossbones indicator is the Hindenburg Omen. Now, the classic Hindenburg Omens apply to the NYSE, not to a combined NYSE and NASDAQ. I've done some work of late suggesting that the markets have changed, and with the technology-driven NASDAQ, probably can be looked at on the NASDAQ as well. So you see Hindies and bangos, which are never a good sign. When you look at stocks above their 200 in orange, stocks above their 50 in white, and then you can look, and then you look at yellow is above the 50. White is above the 200, and orange is the 50 above the 200. You don't see a market that shows strength. This is strength when the yellow is above the white, above the orange. We're inverted there, so it's still a weak market there in general. You could see here that growth is leading and large caps are leading. And you also notice there's no green dots occurring here. So despite the strength and growth in this market, there's not a lot of underneath of support. So this would be caution for the bullish approach. If we break out the NASDAQ and the NYSE, you could see we've had a series of Hindenburgs on the NYSE and the bangos on the NASDAQ. I do make decisions based upon a objective model. I call it my weekly timing model, easy to construct in pretty much any system that you have. We've been long since November 6th on the spiders and the Qs. The bottoms of the market occurred a week before. I'll take being a week late and staying in. The diamonds, we are on the verge of going long. We are sort of in what I call caution land, where price is above the WMA, but the bongo hasn't flipped yet. And the Russell just doesn't do anything. It's kind of in a sideways mode. But I've got nothing that's overtly horrible looking there. And I have two that are long, so the model still tells me to be long. If I looked at the daily, you'd see a little bit even better with the diamonds being long on the daily as well. Now, everybody talks about the equal weight. So these are some HDSI charts. The upper left is the QQQE. The lower right is the RSP. Just as a side note, my go-to for Hindenburg omens in the NYSE has been for almost forever, has been HGSI, www.highgrowthstock.com. Whoops, and you can notice these little red lines here are the Hindenburg omens, which tell me that I'm not just seeing Hindenburg omens because programs are different. I think that the Hindenburg omens are real. They won't fire in all the different programs at the same time, and that's something that always bothers me. But I think a lot has to do with what underlying index we're using. But when I see that many on any program, I pay attention. Notice on the equal weight Qs, we hit this trend line or this resistance line multiple times. We broke above it on Friday. Is that anything big? I don't know, but you could certainly argue that I have it. Ascending triangle here after a bullish run, which could be considered a continuation pattern. You look at the RSP, it's not as pretty. I'm in a triangle here, and this is one that could go either way, but I'm sitting on support. I am doing this after a significant uptrend. This too could turn out to be a continuation pattern. I like the QQQE much more than I like the RSP. Imagine what happens, certainly over a short-term period of time, if these markets break out to the higher on the broader indexes. The Nick Drendel tool, a great tool to watch during the day to tell you what's working, what's not. So what I want to point out, the good and the bad and the ugly. Closing ranges. The major indices closed right off the highs of the session. So even though the Q Edge tool showed me participation wasn't great, you gotta love markets that close at the highs of the session. What else does it show me? It shows me the short-term and long-term moving averages are heading up, and it shows me that each of these are above their 820, 150, and 200. Bullish. It shows me over here that on the one day the leadership was gold miners. Gold had a great week. Now over the last couple of months it's been up, but it's been a laggard. Semiconductors had a good week. We're flat on Friday and have been the leaders over a period of time. And I don't know why anybody plays marijuana stock. Someday we'll approve marijuana in the US and I bet you get a short-term pop and then it goes back down into mediocrity. I think about Tilray and meeting some guy at a wedding who's so proud because he had a massive position at $300. I think he has the same massive position at $1, $2, $3 as well. Cannabis is just tough. So the thing here that does worry me is in the lower left. Now, to be fair, the new high, new lows actually improved on Friday, but I'll show you in another graph. It's hard to build bulls off of new lows. Rates fall. Is the economy cooling enough? Well, we had some data this week, especially around employment, that the market got all excited and the talk of a September cut is back. I just wonder when we get too close to the election for us to not cut. But you could see here on the week, the 10-year was down 1.63, the 30-year was down 0.76%, markets in yellow higher, rates lower. Recession in our near future, I'll give you the same story. We will have a recession someday, just not today, not tomorrow, and I don't think anywhere soon. Why? Why will we have a recession? This is the 10 minus 2 on the upper left, 10 minus 3 on the upper right yield curve. The gray lines represent recession. The black line here is where we invert if we go below. And notice every time we go below, we have a gray bar when we cross back above. Well, it's hard for me to believe that this time is different, but we are still well below the inversion. How will we uninvert, revert, whatever the right word is? Well, we'll revert when the Fed starts cutting short-term rates to stimulate the economy. Why? Because the market's probably going into a recession. Or if the long term start going up, which I don't think that would be a good thing. So not yet. Down here, credit tightness. It spikes kind of coincidentally or going into recessions. It hasn't spiked. And then if you look here at the Philadelphia Fed Diffusion Index, we're still above the black line, which means our economy isn't sunk yet. And the recessions typically occur when you are below minus 20%, and we're not even below zero. So, is there a recession in our near future? There is always a recession in our future. I just don't think it's very near. Breadth, not great, but not horrible. Stocks above the 200 on the upper left, stocks above the 40. Both came down on the week, but they're both well off their lows, and frankly, stocks above the 200s closer to the highs than the lows. The shortest, fastest acting 13-week new high, new low, neutral zone. Now, I mentioned before you need new highs and an up versus down volume to support the bulls. This is from my Trading View package Praveen built for me. And notice that in periods of lots of new highs, lots of UD up volume, advancers versus decliners, you get the painting green area. In periods of weakness, you get the red. And the problem I have is that, on the NYC on the left, we actually did see some new highs, which is kind of cool. But for the most part, there's really been no new highs to support an advance here, and certainly not on the NASDAQ. What about the buckets? So the buckets is a great tool to understand where an individual stock or market is compared to history. Take the Bollinger Bands between 0 and 100% and recognize that only about 5% of the time will you be above the Bollinger Bands and 5% below. So what I did here is you can run the S&P 1500, you can run any index, and it tells me that less than 4% are above, less than 5% are below, and I'll tell you that that's no signal. Here it tells me that on the midline of the Bollinger Bands, half are above, half are below. Yeah, not exactly, but close enough. We're in neutral. This market is in neutral by Bollinger Band analysis. AD divergence is expanded. This bothers me some. For a longest time in blue, the NASDAQ composite goes higher and higher, and the AD line goes lower and lower. That is not a pretty picture. But look what has happened. The Russell 1000 is turning lower on the AD line while you get higher highs. The NASDAQ, and the NYSE has also diverged where the AD lines turn down while the price is going higher. At some point, this is not going to stay this way. Either the markets are going to have to turn down and follow the AD lines lower, or maybe the AD lines reverse. So this is put this in the bothersome camp. Now, as I mentioned before on HGSI, we saw the Hindenburg omens. We've seen some recently on EdgeRater. What I'm just showing you here is it really matters what the underlying index you're using, which is why I think there's variation. I will say the percentage of new lows has dropped and the new highs is starting to go up. So what does the Hindenburg omen actually mean without the math and the gobbledygook? To me, it occurs at times of market risk. The pros are saying, oh my God, the markets are at a high, we need to be getting out. The amateurs like me and others are, oh man, this market's going without me. I need to be getting in. You see lots of volume. You see new highs. You see new lows. It's entropy. And it never do you see a big correction without seeing a Hindenburg firing first. However, saying that, 1 out of 4 of Hindi signals only has minimal pullbacks. This is a confirmed Hindi. Whether I look at the NYSE Common, the All NYSE, and then the NYSE index in HGSI, doesn't mean it's got to be a massive correction. This is a test or a tool that allows me to break up every stock, and I use ERG, which is earnings rank, relative strength rank, and group rank. You combine those three together to get ERG, and look at performance of the market based upon buckets of ERG. And you got to throw out the tails and the heads because there's just no stocks down here. But if you just go from maybe 30 to 270, there's clearly a trend saying the higher ERG, better performance. Now, unlike typical times, this is over 2 weeks because, as many of you are aware, because of my surgery, I didn't do this last week. I didn't keep the data set either last week. Notice that returns were better with earnings and with relative strength. Since I'm predominantly an IBD type CAN-SLIM growth stock trader, it's my kind of period of time when growth is working. Another thing that I think is actually very bullish. Markets can go higher, and typically the leaders lead until they don't lead anymore. And one way that you can predict when the market's going to roll over is build a group of leaders and then track that leadership group with the knowledge that this is probably going to break down before the markets break down. So we did this a month ago in Orange County. God, it seems like forever ago. And these were the stocks that we picked. And notice that we had a nice run, and now we've gone sideways. If that was a stock, would you be looking to buy or sell? I would argue I'd be looking to buy. Certainly a pullback and an uptrend holding at the 17-day simple moving average. To me, is definitely much more bullish than bearish, and I think that's a positive thing. So to me, we're holding. Know your news and earnings. Well, we got some doozies this week. I mean, this is like a lot. We've got Powell speaking to the Senate and the House. Now, think about the House. If I remember my government studies from 100 years ago, I think everybody in the House is up for election come November. Do you think they want a recession? No. A bunch of senators are up. We got a presidential election. I don't think Powell can go in there and start blowing up that the sky is falling. So hopefully it's going to be non-events. You got jobless claims Thursday morning, and then you got the CPI Thursday, PPI on Friday, and you got additional Fed heads speaking on Thursday. It's going to be an interesting week. If we see continued number hits on CPI and PPI or a little bit of weakness, even better, I think the markets will go higher because they're starting to think about that September rate cut again. Earnings are starting. It's interesting, Greenbrier sold off as the day got later on Friday. I wonder if people are getting nervous about earnings, but we'll see. Not a lot this week, but there is. Industrial, airline, banks and investments. There's a lot going on. Judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So let's go back to the breaking up is hard to do theme. So again, I'm going back to when I was just a little kid, and boy, was I stupid. Imagine if we knew what we knew about life, what we know in our 60s, if we knew when we were 12. You wouldn't be sitting there with a dandelion or some other flower and pulling off the petals. She loves me not. Think about the market here. The loves me, the bullish part of the market. The timing model is mostly bullish. Spider and Qs are at all-time highs. Equal weights might be getting ready to break out. Strong seasonality in July. Potential rate cut for September back on the table. All-time high markets usually go higher, and the leaders index is not broken. That list there is why I can't be bearish right now. But what about the loves me nots? The bearish side. Many topping signals. Bangos, Hindenburg omens, divergences, lack of new highs, lack of bullish impulses. Everything's still very data dependent. And we've got some election turmoil coming. We should someday maybe I'll do a talk about the night of Trump's election. And I'm a moderate. I don't care what party, as long as it was moderate. Unfortunately, that's not the world we live in. But I remember sitting at a hotel in New York, and I was getting decimated watching the markets. And at 1 o'clock, 2 o'clock of election day, I decided I'm going to sleep, and just figuring my portfolio was going to get hammered the next day. And I remember waking up, and the futures had a big recovery. And by the end of the session, even though everybody told us the market was in bad shape if Trump won, it turned out to be a pretty positive period of time. But that's turmoil, and it's coming. Thoughts, so all-time highs on NASDAQ and spiders, mega caps led. Growth is starting to be a concern now. Manufacturing showing some contraction, employment softer. But I think that bad is good period right now, as long as it's not too bad, and that might drive us closer to a cut. Markets likely to go higher and a peak in July would not be unusual. I find it hard to short this market. I'm still mostly long with a nice cash position. The cash is actually higher than I'd like it to be because I closed several positions pre-op. I have my shopping list ready, but I'm still going to be cautious. Hope to see you at Wealth 365 event, and again, I'll have the links in the underneath the video. Now let's take a look at charts. If you've not been here before, basically I spend half of my time telling you what I think the market's going to do and why, and then I'll go into a program, and I'm using wealth charts predominantly this week. I'll probably do a midweek update using some of the other tools I have, because I know that some people like to see one program, some like to see the others. I think certainly the dominant one is wealth charts, and that's why I use it. I already showed you the weekly timing models were positive for the spiders and the Qs. Here's the daily model, and just to show you that we're also been long now for pretty much 2 weeks on the diamonds. I put this in here when we gapped up, and that was sort of my line in the sand. It has not been retested. And so I really, if I have to predict, are we going higher or lower? I think we're going higher here, at least for a while. So as I said earlier, I'm looking more long than short. Let's take a look at the indices, and let's blow up the 5-minute. And let's just look at, remember it was a 4-day session. So that means, let's get my days right. So here is Friday. And then here is the shift from Friday to Wednesday. Wednesday to here's still Wednesday. Yeah, it seems like I'm missing some days, some periods of time here. So should be very careful then, I think, what I do with this one. Let me just play with this for 1 second. Yeah, something's weird here. So I'm just going to skip this just because there's no data for the second. 9:35, 9:40, and right away. Yeah, something happened on my 5-minute chart there, so let's just blitz off of that and go back to the dailies. No biggie. If we look at the daily chart, and this here is the S&P 500, and let me set this the right way, because triangle up, okay, triangle down, okay. You could see here is that gap, closed at the high of the session. This white line says that there's risk of some divergence. We've already talked about divergence. The arrow here is an EMS signal. Nice bull run on the S&P 500. Yes, we're getting extended. High jump is at 93.6, so it can get a little higher. Notice the yellow on the MACD is crossing above the red, and there's a little bit of nubbing of green on the histogram. Do we have a little bit of divergence here on the RSI? Probably, hence the white line showing up here. What can you say? Super strong. Yes, there's risk there. Up on Friday, 0.5%. If you look at the NASDAQ, I could say almost exactly the same commentary, up 1%. If you look at the diamonds, again, is that bearish looking? No, it's actually a nice uptrend after this pullback, and it continues to move up. Here it was up 0.22. And if we look at the Russell, this is the one that's kind of disturbing. We're back in this channel. I may have to make this channel wider to capture. To play with this later. To capture more of this movement. But we're going sideways on the Russell. We'd expect the VIX to have been down on the session, and it was up 0.32 off of dramatically lower on the weekly. And if you want to see one reason the markets are going higher, look at the dollar. Strong up channel, came out of the channel, ran parallel to it, and broke down this week. So the dollar was down 0.35% on Friday. A weak dollar would be very supportive of the markets. In fact, I forgot to turn this on, I think. Let's see. Yep. All right, let's go look at commodities. Weak dollar, gold and silver. You know, we could stop right now and say just buy gold. I mean, I bought into a number of gold positions at the end of the week. I had some Eldorado gold already. Gold looks very good here. It's looked good for quite a while. When you see lines on the chart, it tells you I've been looking. And this was a beautiful breakout earlier in March. Silver also broke out at the same time, broke out again. Oil has had a big run up, which is interesting. We'll see if it doesn't get into double top area. Natural gas remains dead. And then another reason to be happy about this market if you're long is the 10-year broke down here, down 1.8 on Friday. And really, I think it's an important breakdown. If the 10-year continues to come down, boy, if the 10-year comes down to this level, we're going to get a nice bullish move in the market. No question about it. If I look at the sectors, and these are ratio charts comparing the individual S&P 500 sectors to the spider, and I'm looking for long blue lines at the end of the week showing strength in communications here, and I'm looking to things pointing up here. So where is there strength in this market? There's a lot of weakness compared to the spider, but a couple of things I want to point out. One, technology continues to lead. Discretionary, which was weak for some time, has had a big move. Communications is starting to move. Kind of the same old, isn't it? This is what led us here in the first place. But it's good to see some broadening from just technology by itself. Biotech, this is healthcare, which looks kind of awful, but biotech actually is off the bottom, and that's something else that I've been watching. So there is increasing strength here. A week ago, 2 weeks ago, there may have been one thing that I would have said positive things about. We go into the scanners. Let's look at the heat map to start. And you'll see that on Friday, a lot of strength, especially in big cap tech. Tesla was a monster this past week. Now, is it going to go to the moon? Pretty powerful breakout at the minimum. Or is Tesla had a big run, its high jump is now at 100, it needs to take a breath. Seasonality was its friend. Its orders, although when you look compared to other dealers, didn't look great. But these things are all about expectations, and versus expectations, they were a big win. So you had to like Tesla. Apple, the crown of this market, broke out of this little flag, higher highs, all-time highs. Slowing earnings and revenue doesn't seem to matter. Meta, breakout of consolidation, also a very bullish sign, all-time highs. Nvidia, This one's different. Now, am I surprised? No. NVIDIA just had a 10 for 1 split. And after splits like that, it's not unusual to see things pull back. But is NVIDIA getting ready to run, coming out of a squeeze? I'll just leave it as a question. And one that we'll come back to that I like a lot this week is AMD, and included in the reason why is seasonality. And then I just want to talk about another recent 10 to 1 split, or some kind of a split. Was it 10 to 1 or was it even bigger? $36. I think it was even bigger. I can't remember what the split was. 50 to 1 split. My God. Have you ever? I've seen reverse splits 1 to 50. When's the last time we saw a 50 to 1 split? I'm sure it's happened before. I just don't know. I've never seen a 50 to 1 split. So what happens? Here's your nice little sell-off when the split was announced on the 25th, and same just in this period of time. But if you wanted CMG but couldn't afford a $3,600 stock, CMG has pulled back a little bit, and that's been just a monster. So big cap tech is strong. Something like Lilly, also strong, being driven by the GLP-1 craze. The weight loss drugs that are diabetes drugs, kind of giving a little bit of a consolidation up here as well. Google's another one in the big cap tech space that looks really good, nice uptrend. As is Netflix, breaking out to, if not all-time highs, near all-time highs. I think it got back up to the 700 range in the distant past. So let's just look at that here. Let's put on monthly. Yeah, we're kind of at the all-time high level. Unbelievable how this market is. This has got to be, and I've heard it said many times before, just one of the most hated bull markets of all time. If we look at the wealth scanner, one of my favorite tools in wealth charts, because it allows me to rank things by whatever list. And I put together a list of what I call my top-down ETFs. It's got industry groups, sectors, themes. And what it shows me is software is leading. Kind of looks like Netflix, doesn't it? Well, discretionary, cybersecurity, Russell 1000, large cap, NASDAQ composite, FANGs, Spider Growth, U.S. stock market ETF, core S&P 500, Qs, S&P 1500, core growth, spiders, S&P 500 growth, Russell 1000 growth. Guys, girls, me, if you don't believe this market is broad-based strength, why are these broad-based ETFs, including things like the NASDAQ indexed, the Qs, the Spider Growth, the total U.S. market, core S&P 500, S&P 1500. There's more to this market than the MAGs. Strength. Part of why I'm more bullish than bearish. Look how many of these groups are above 800. The worst there is 780. There is stealthy strength beyond those MAGs that loves me more than loves me not for this bull market. Let's see if we can find anything that looks interesting here. In fact, let's just start with AMD. So what I like to do is I like to rank the market, looking for pullbacks in uptrends. And let's just go and let's look at my buy watch. It's going to be a little different this session instead of going very broad. So I put together a list of stocks that I'm going to be watching closely. Just because I call it a buy watch does not mean I'm buying any of these. It means that they're stocks that looked interesting to me. And although it doesn't show up here because I'm looking for specifics, let's broaden it. I'm not looking for pullbacks anymore. let's look at AMD and let me talk about why I like AMD. The reason it didn't make my pullback and uptrends list, okay, in case you're wondering, is because the weekly bongo is still red from this pullback. It is very close to flipping to green. Why do I like AMD? Because I like pullbacks in uptrends to major support. This yellow is the 50 and breakouts. So I have a stock that I've historically liked. Boy, was that a reversal candle, which has pulled back and is breaking out from a consolidation area. This tells me the volume on Friday was good. It's got momentum. The breakout candle actually was the back here a couple days earlier. It's coming out of a squeeze, so it's building up some energy to potentially go higher. It is not extended. Relative strength versus the spider is positive, as is OBV. I like pretty much everything I see here, and it's a pretty deep pullback. That's the only thing that goes against it. Earnings are not out yet. Looking at growth of 63 versus 58 cents. Do like that feature. Now, one of the nice things about wealth charts is built-in seasonality. So let's take a look at AMD. And let's look at AMD July 3rd to August 7th, 4 weeks. 8 times up, 2 times down, average return is 1258. If you look at from today and look out 4 weeks, 10 years of data minimum, you see a projected increase of 16.63. So here is a scanner looking at the NASDAQ 100 and looking at seasonality. There's probably 40 to 50 stocks in this list. Look at the season. Now it's all 100. Look at, not all the 100, but look at all the positive seasonality in the NASDAQ here. NASDAQ 100 is in a very strong time of year. Look at how the seasonality has tracked reality here. I think we got a pop in AMD coming. So I like AMD a lot. I like it because of the seasonality. And I like AMD because of the chart pattern. What's not to like when you can get a double on that? All right, what else do I like? I think that gold looks very interesting here. If we look at GLD, uptrend, sideways consolidation, and a breakout, not extended with relative strength and OBV confirming. Now within the gold complex, one I liked a lot was KHC. Nope. What is Kinross Gold? Try this again. KIN. KGC. My bad. So you see a nice uptrend, a pullback, breaking out to higher highs. This is a low-cost gold stock. I like Kinross Gold. Another one that I liked, well, I liked a lot of them. So let me just go to my buy watch list and not scanning it. A lot of stocks I liked this week. That's the combos. I didn't like that many. I looked at a lot of charts, but not them. All right. Okay. Numa, if you want big gold and one that's not extended, here's a stock, kind of a cup, handle, breakout, maybe. I mean, I'm probably saying too much. Coming out of a squeeze, breakout momentum, relative strength, and OBV look good. Newmont Gold. So KHC, Newmont. I know there's a couple others here that I liked as well. AEM was another one of the miners. Uptrend, pullback, this kind of looks what I expect AMD to do, to break out. So if that dollar stays down, I would expect us to continue to see strength in gold and silver. Another tech name, tech discretionary name, and this one sometimes is hard to handle because there's a lot of volatility, but we're in a long-term uptrend. This is Mealy, you can see over here on the weekly chart, Mercado Libre. And we're breaking out off of the 50 with breakout and momentum. Relative strength and OBV, at least relative strength looks good. Not extended. This one I thought looked interesting. It's an interesting buy point. I think it's a stock that my guess will be continuing to go much higher. Don't understand too much about this company here, WestRock. Might be a specialty chemical company. But again, uptrends, pretty big pullback, took out the 50 here with an EMS signal. Look at the volume that's come in. Love to see that volume. Out of a squeeze, breakout momentum, not extended, relative strength and OBV turning up. I like WRK, KNSA. See if I can figure out why this one made my list. So there was a lot of pharmas and biotechs that's starting to look interesting. And this is one, I don't know this company from Adam, but just looks like it's tightening up here. It's coming out of a squeeze, broke out above the 50. Relative strength and OBV look good. I'd just be very careful with my stops, but this is one that made my list. And if you like cheap stocks with pretty patterns, and I have no idea what Census Healthcare does, and for all I know, this could be a cheap meme stock. But why do I like it? Breakout, pullback, right to the 50 with a breakout in momentum. Relative strength looks good. This thing looks like it's going to go higher, and this is not a horrible pattern when you look at it on the weekly charts. I don't think that is a meme stock pattern. And you want to see a meme stock? I mean, I grew up listening to Koss headphones. They weren't exactly high quality. I sold them to pay for med school. And I saw this pattern, and I go, what the? I won't say the next word. What has happened? And then I found out why. I think Roaring Kitty and the meme brothers and sisters got behind KHC. I don't buy meme stocks just unless there's a story to them. Now let's just lastly go back to the CAT scanner, and let's throw in the combo buy list. Just see what comes up to the top, and then I'm going to say goodbye, and I like to look at pullbacks and uptrends. Macy's looked like the company that owns Macy's was going to potentially acquire Nordstrom's. Won't be a lot left in high cost retail, which means we'll have pricing power. Phillips, I guess it's gappy because it's a ADR. And I probably would want to know what happened in here. Upgrades to neutral, well, that's always a great thing. Upgrades to neutral, target price 0. Earnings, 28 versus 24. None of that looks particularly strong, and then outperform, but big move up, pull back to the 50, which I call free parking, and a move above that, volume, breakout momentum. It's interesting. I'd have to find out more. Here's your Nordstrom's, which just like Macy's. If you're hearing noise in the background, that's my little granddaughter. She can do no wrong. Walmart, beautiful run, sideways move, moving up off the 17. I like that, looks of that chart as well. But you can see just by scanning a lot of good looking patterns come up. This one is another one here. Sideways, move up, sideways move. Off the bottom, we'll see if that turns out to anything. And then I'll just finish with OKTA, one that I like a lot. Someday this thing's going to work, but nice long-term uptrend, pullback. You made a poopy, and all the people on my broadcast are happy to hear that my 2-year-old made a poopy in the toilet. Good job. Congratulations. I'll go buy you a present. Things you learn as grandparents. That actually is pretty cool. Now I know why she was knocking on my door and wanting to come in to tell me. All right, well, can you end it on any better than your 2-year-old making poopy in the toilet? I hope I didn't offend anybody by being part of normal life. Again, thanks to all the well wishers over the last week. I'm through the worst of it. I hope to continue to get stronger. And, you know, getting older sucks, but the alternative isn't so hot. Hope you have a great week in the market. Hope to see you at the Wealth 365 event. Thank you.